You get a text. Low balance alert. You barely notice it anymore. Your card still works. Your coffee still gets paid for. Your bank just quietly stepped in and covered the gap. Feels like a favor. Feels like your bank has your back. But here's what's actually happening. That coverage has a price tag attached, and it's one of the most profitable products your bank offers. Not loans, not mortgages, not even the interest on your savings account, which barely counts as revenue at all. This overdraft protection sounds like a safety net. In practice, it's a short-term loan you never sat down and agreed to the real terms of, priced at an interest rate that would be illegal almost anywhere else in the financial system. Think about what just happened in that transaction. You spent $5 you didn't have. Your bank covered it instantly, no questions asked. And for that $5 favor, they charged you somewhere around $35. Do the math on that. If you paid that $5 back within a few days, the annualized interest rate on that loan can run into the thousands of percent. A payday lender charging that rate would face lawsuits in most states. A bank charging it gets called a checking account feature. Same math. Completely different reputation. Here's the part that makes it clever, not just expensive. You opted in. At some point, probably when you opened the account, sitting across from someone or clicking through an app, you were asked a simple question. Do you want your card to work even if you don't have enough money in your account? Say yes and you feel protected. Say no and your card just declines at the register. Embarrassing. Public. Immediate. Most people say yes, not because they did the math on what that yes actually costs, because nobody wants their card to fail in front of a cashier, or in front of a date, or in front of their own kid at the grocery store. That single yes is worth more to your bank than almost anything else you'll ever sign with them. Overdraft fees aren't a side effect of banking. They're a business line, a deliberate one, with its own targets and its own place in quarterly earnings reports. Large U.S. banks have pulled in billions of dollars a year from these fees alone. For a long stretch, it was one of the highest margin products on their entire balance sheet. Unlike a mortgage, there's no risk assessment involved. No credit check, no collateral, no underwriting meeting, just a $5 coffee and a 5-second decision you made months ago without thinking twice about it. And the fee structure isn't random, it's engineered. Notice how transactions post to your account. You'd expect your bank to process them in the order you actually made them. For years, many banks didn't do that. They reordered transactions from largest to smallest before processing, so that one big payment hit your account first and drained your balance before your smaller, earlier purchases even came through. The result? Instead of one overdraft fee for one mistake, you got 3 or 4, all from a single afternoon of ordinary spending. Regulators eventually pushed back on the most aggressive versions of this reordering trick. Lawsuits followed. Some banks settled for hundreds of millions of dollars over it. But notice what that tells you. The practice was profitable enough to be worth the legal risk in the first place. The incentive that created it never actually went away. It just got a little more careful about how it shows up. Here's the twist that should bother you more than the fee itself. The people who pay the most in overdraft fees are not careless spenders throwing money around. They're the people living closest to zero, tight budgets, inconsistent paychecks, a gig work deposit that lands a day late, a bill that clears before payday instead of after it. The overdraft system doesn't really tax bad decisions. It taxes thin margins. It taxes the exact financial position that most needs protecting, not from embarrassment, but from a widening hole. A small share of customers account for the overwhelming majority of overdraft revenue industry-wide, not the average customer dipping into the red once a year by mistake. A repeat group, cycling through fee after fee, month after month, because the underlying cash flow problem never actually gets fixed. The fee doesn't solve the shortfall that caused it. It adds to it. Every overdraft makes the next one more likely, not less. That's the real design, even if no single person sat in a room and designed it maliciously. Overdraft protection isn't sold as a loan because loans require disclosure, a stated interest rate, clear repayment terms, a cost you can compare against other options. Frame the exact same product as protection instead, and none of that scrutiny applies. You feel like you're being shielded from embarrassment. You're actually being underwritten at an interest rate no regulator would ever let a bank advertise honestly on a billboard. So why has this started changing even a little in the last few years? Pressure. Regulators started asking the obvious question out loud. If this is functionally a loan, why doesn't it look like one, cost like one, or get disclosed like one? Consumer advocacy groups publish the math in plain language, the kind that's hard to argue with once you see it laid out. And some of the largest banks in the country responded by cutting their overdraft fees dramatically, with a few dropping them close to zero entirely. Was that a change of heart? Almost certainly not. It was a recalculation. Public attention and regulatory heat made the old pricing too risky to defend, and the potential fines and reputational damage started to outweigh the fee revenue itself. When something suddenly gets discounted with no real explanation from the company offering it, that's usually your signal that it was overpriced to begin with, and everyone involved knew it. But here's the catch. Most smaller banks and credit unions never made that change. The fee is often still sitting there in your account agreement, in language you scrolled past during sign-up, worded just carefully enough to sound like a benefit rather than a cost. So what do you actually do with this? Open your banking app right now while this is fresh. Find the word overdraft in your settings or your account disclosures. See if you're currently opted in to what's usually labeled courtesy coverage, standard overdraft coverage, or an overdraft line. If you are, in most cases, you can simply turn it off. Your card will decline instead of quietly, expensively succeeding on your behalf. That feels worse in the exact moment it happens. It's cheaper every single time after. There's also a middle option worth knowing about. Many banks let you link a savings account as backup overdraft coverage. Instead of the full overdraft charge, you usually pay a flat, much smaller transfer fee to move money from savings into checking automatically. It does the same protective job the expensive version claims to do at a fraction of the cost. Almost nobody sets this up, not because it's hard, but because nobody walks you through it at account opening. Explaining the cheap option isn't in the bank's financial interest, so it rarely gets mentioned unless you ask. None of this means your bank is secretly plotting against you as an individual. It means the incentive underneath the product is quietly misaligned with your interest. A feature framed as protection generates more revenue the more often you slip into the red, not less. There's no built-in reason for the system to nudge you toward closing that gap for good, because the gap itself, repeated month after month, is the product being sold. Compare this to how your bank treats you when you actually apply for a loan. Ask for a personal loan, and suddenly the process slows way down. Credit checks, income verification, a clear disclosure of the interest rate printed in a box, required by law, impossible to miss. Every cost is spelled out because regulators require it for anything officially labeled as lending. Overdraft protection skips every one of those steps. No application, no waiting period, no box with a printed rate. It moves at the speed of a tap, precisely because it was never built to be scrutinized the way a loan is. If you pitched a new financial product today that charged the equivalent of a payday loan rate with zero underwriting and instant approval for anyone with a checking account, compliance departments would reject it outright. Overdraft protection exists because it was never designed from scratch. It grew quietly out of an older, more forgiving system, and it kept its grandfather's status while everything built after it faced far more oversight. There's a psychological layer here too, and it's worth naming directly. Banks understand something about how people relate to small invisible costs versus large visible ones. A $35 fee buried inside a transaction history doesn't register the same way a $35 sticker price would at a store. You'd think twice about paying $35 for a $5 coffee if someone asked you up front. Nobody asks you up front. The charge shows up 2 days later, folded into a list of other transactions. Easy to skim past, easy to forget by the time your next paycheck lands. This is why so many people underestimate how much they've actually paid in overdraft fees over a year. Ask someone how much interest they paid on a credit card last year, and there's a decent chance they can guess, because the card statement puts it in one clear line. Ask the same person how much they paid in overdraft fees, and the number is often a genuine surprise. sometimes running into hundreds of dollars, spread out just enough across the year to never feel like a single obvious cost. Here's a habit worth building instead. Once a year, actually search your own account history for the word overdraft or insufficient funds. Add up every fee you were charged. Most banking apps let you filter transactions by type, which makes this a 5-minute task. Seeing the yearly total in one number, rather than scattered across 12 statements, tends to change behavior fast. It's the same reason subscription costs feel harmless month to month and shocking once you add up the full year. If you do find you're a repeat overdraft customer, the fix usually isn't more willpower. It's structural. A small buffer of even $100 or $200 sitting untouched in checking absorbs most everyday overdraft situations before they ever start. If building that buffer feels impossible right now, that's useful information too. It usually means the real problem isn't a stray $5 coffee. It's that your income and your expenses are timed against each other in a way that keeps pushing your balance towards zero right when bills land. That's a cash flow timing issue, not a spending discipline issue, and it calls for a different fix. Shifting a due date, requesting an earlier pay cycle, or building a slightly larger buffer over a few months rather than trying to hit zero risk overnight. You get a text, low balance alert. This time you know what it's actually offering you, not protection, a loan, priced like nothing else your bank sells you, wrapped in language soft enough that you'd never think to call it that.